Hi, good morning, everyone, and welcome to another session of Decipher with Deserve. Today is Saturday, the 14th of March, 2026. I'm Kushal Karkare from the investment team at Deserve. I work on portfolio analytics and market insights. And thank you very much for taking out the time to join us here on a weekend. We truly appreciate it. Now, over the past few weeks, geopolitical tensions have once again come into focus globally. Energy markets have turned volatile, shipping routes and supply chains are being closely watched. And crude oil, which remains one of the most important macro variables for India, is once again at the center of investor discussions. Whenever oil prices move sharply, the impact rarely stays confined to energy markets. Oil influences inflation, currency stability, government finances, liquidity in the banking system, and eventually corporate earnings and equity markets. And naturally, a familiar set of investor questions begin to surface. How exposed is India really to this disruption in global oil supply? How do oil shocks travel through the economy, from inflation to currency to growth? And how far do those ripples really go? And perhaps most importantly, how should investors navigate portfolio volatility during periods like this? To help us decode all of this, joining us today are two seasoned investors who bring deep experience across multiple market cycles. First up, we have Ganesh Ram Jairam, who is the Chief Investment Officer and Head of Public Equities at Avendis, where he leads the firm's public market investment strategy. With over 2 decades of experience in equity research and investing, he is known for identifying high conviction, contrarian opportunities through disciplined, insight driven investing. Prior to Avendis, he held senior roles at Spark Capital, CRISIL, HSBC, and Standard Chartered, building a strong track record in fundamental research and long-term investing. We are also joined here today by Vaibhav Porwal, co-founder of Deserve, who brings over 20 years of experience advising and influencing investments of some of India's largest families. Over the course of his career, he has overseen the management of more than 50,000 crores across his various roles. In his current role as CIO at Deserve, he helped shape the firm's investment philosophy and overall portfolio framework. Ganesh Ram, Vaibhav, welcome. Great to have you both with us today.
Thanks, Kushal. Good being here.
Thanks, Kushal.
Yeah, just just a second. Let me share my screen. Yeah, so folks, before we dive into the action, a few housekeeping notes. We There'll be a Q&A section that is open throughout this session. Please feel free to drop in your questions as and when they arise. We'll try to address most of them towards the end. You'll also be faced with a short feedback form at the end of this session. Please do take out 30 seconds to fill that out. It really helps us to come up with better content week on week. With that, let's get right into it. If we look at markets historically, oil prices have been one of the most important macro variables influencing equity returns in India. The chart shows that when crude remained in the 40 to 70 region, equity markets in India have generally delivered strong forward returns. But when crude has moved above $80 a barrel, forward returns have historically been weaker. Ganesh Ramji, let's start with you. From an investor's perspective, why does crude oil become such a critical variable for Indian equity markets?
Morning, everyone. Thanks for this opportunity to talk to all of you. Uh, yeah, crude is actually India's biggest driver of how markets, how the economy, how earnings, and how multiples have trended and impacted our returns. And crude in not just in that sense, but its impact on the BOP, its impact on the currency, its impact on capital flows, its impact on inflation, how Reserve Bank takes action, they're all interlinked, and that's why. And of course, the most important variable is the BOP impact on deposit growth. In the banking system, the systemic liquidity, which drives the fuel for credit growth and our government's borrowing to spend. So the importance is extremely high, and that is why whenever our tolerance threshold for crude. If you had asked me this question in 2004 or 2003, when the Iraq war started, if you remember, at that stage, our India's tolerance threshold was $40. Okay, but as the years went, India's IT sector grew, our non-IT services exports, which is basically our GCCs and business services, that grew. Our NRAs started sending more money back to India, that went up. So our tolerance threshold has moved over the last 20 years from $40 20 years back to $80 currently. Somewhere in this $80 to $90, our tolerance gets tested. Okay. And that's why when it crossed the threshold in the last 15 days, as you have seen consistently in the last 20 years, if you say it as 25 years, the number changes. But in the last 20 years, we have seen as it went goes past 80, markets get jittery, and because it has a ripple effect into various dynamics of the market. And that's why the 1 month, 3 month, 6 month, 12-month return when oil is 80 plus, and that's what this table tells you, has always had its negative effect.
Understood. Vaibhav, when oil starts moving sharply like this, do you actually change portfolio positioning, or is it more about managing volatility rather than reacting to oil prices directly?
No, so great time to have this webinar. I was reading this book called Choke Point about a few months ago, and where there was specific mention of economic warfare, and Strait of Hormuz was mentioned multiple times in that book. And I never imagined that it will play out so quickly in real world also. But now it's playing out. See, the way we look at the portfolio is at two dimensions. First, we need to understand whether this disruption is short term or long term in nature. Right now, it's very difficult to say whether it's long term, and I would lean towards saying that this should not last beyond a few weeks or max a few months. So, in that context, to take an extreme action in the portfolio will be difficult. However, we are stress testing our portfolios at three dimensions. First, impact of high crude prices on specific companies. Second, impact of currency movement on each company's earning, which is there in our portfolio. And third, impact on demand for each of our companies which are there in the portfolio. These are the three dimensions across which we are stress testing the portfolio. If we believe that there is a change and this war can remain sustained for a long period of time, then we'll make the necessary changes in the portfolio. Right now, we are going through the process of stress testing. And obviously, as Ganesh mentioned, it's super important to look at crude prices because the interlinkages are significant. And this is the first time, and International Energy Authority has also admitted that there is the biggest disruption in supply chain which they've seen in the history of oil. So if you look at normal data points, oil supply is higher than daily demand. So daily oil supply is about 108 million barrels, and oil demand is 106 million barrels. So that 2 million barrel excess per day is there. But the moment you take Strait of Hormuz out of equation, you're talking about a shortfall of 18 million barrels per day. How much ever you try, you can't substitute that kind of supply disruption with any alternative source. So there will be a substantial impact, and it's playing out in real time. The only question is for how long it will last, and impact of that on India's finances and corporate earning is something that we need to stress test.
Yeah.
Got it. So, the reason oil matters so much is that, as Ganesh Ramji mentioned, it flows through India's balance of payments. Oil's price spikes widen the current account deficit, affect the currency, and eventually influence liquidity in the financial system. Vaibhav, how closely do you track currency and capital flow dynamics when assessing market risk?
See, extremely important. One of the key parameters that we consider while constructing portfolio is liquidity in the system. And liquidity in the system can mean global flows as well as domestic flows. And if global flows slow down, and if there is a pressure on rupee on account of global flows slowing down, RBI will also be forced to act. They will sell dollar, and we've seen this play out over last 10 days. Our forex reserves have gone down from 728 billion to 716 billion dollars in a span of 10 days. So that's $11 billion worth of dollar selling, which RBI has done, which means they are pushing out rupee liquidity from the system. So if this liquidity moves away from the system, that will definitely have adverse impact on the market.
Got it.
So this obviously becomes a critical indicator for us. It triggers a chain reaction. If flows are slow, there'll be pressure on currency. If there is a pressure on currency, RBI will have to act, which will put pressure on liquidity in the system, and which will put pressure on interest rates, and that will put pressure on equity. So it becomes a vicious cycle, and that impacts the market in every possible way.
Got it. Ganeshram, from a broad market perspective, when balance of payment pressures start building, what are the early signs investors should watch? And if you could just briefly walk us through what we're looking at in this slide.
Yeah, yeah. So if you see this slide, what I wanted to highlight here is if you look at the last 25, 26-year data, and you look at years like 2003, 4, 5, 6, 7, 8, or till about FY 8, okay, India, in the context of the various colors, it's more various shades of green, which means that the current account is not posing too much pressure in the system. In spite, there have been years when oil spiked, even those years, Iraq war and others, but exports were growing or IT was booming, and you still didn't feel the pressure build up. And that is why the capital account, which is the column next to it, saw good flows. And if you see the third column, the BOP as a percentage of GDP was healthy, anywhere between 2.4%, 3.3, 5.2. That's the best year, FI4. And then even FI8, when markets went into a absolute bubble territory, that number went into 7.6% of our GDP, right? And that means when BOP is high, so much capital flows from outside India is flooding into India. The rupee appreciated. If you remember, it went to 38 rupees per dollar sometime in late 7, early 8. And, and that led to equity markets doing extremely well. Okay. But if you see subsequent years, FY 9, 10, when that BOP number started declining, going into negative trajectory, markets weakened. Initially, it was in FY9, the global financial crisis. In 2012-13, oil went up to $110. It was the Arab Spring. It was the taper tantrum was playing out. So if you see the current account, it went India, gold spiked because gold becomes a hedge against inflation. So Indians bike into gold dramatically, as what's been happening in the last 12 months also. So that leads to a current account weakening, and again the rupee pressure starts. Then again we started improving. Then what we saw in FY26 till February, okay, till maybe middle of February, when oil was in the 60s dollars per barrel, even then we were facing the brunt of tariff, of AI-led pressure. And if you see that number, FY25 capital account, that penultimate row in the third column from the left, $16 billion of capital flows. Whereas in a year like FY8, which is 15, 16 years back, India saw more than $100 billion capital account flows. Those FDI, FPI flows trickled down. That put pressure on the BOP, and we saw pressure on markets again. So very critical macro data point, which has historically every year impacted equities, the BOP. There are various elements within BOP, but within that, the crude has been the most important.
Understood. So now bringing the discussion closer to the current geopolitical situation, a meaningful portion, near about 20% of global crude shipments passes through the Strait of Hormuz, and India sources a large share of its oil imports from the Middle East. Ganeshram, how real is the risk of supply disruption in such key energy corridors?
Correct. So why you see this number 33% and not 20 is because I have taken the proportion of seaborne global crude. Okay. So there is a lot of crude which happens, which gets transported through land also. I have excluded that. I've just taken what goes through the sea. Okay. So through the sea, if you see crude, it's or be it fertilizer or other chemicals related or crude related elements like say gas or methanol or etc., the number is quite significant. And for India, it is even more because almost 50% of our crude oil and almost our entire gas, not entirely, but large chunk of our gas requirements come from the Middle East countries. Okay, though the proportion of rest of the world, especially Russia, now US, and hopefully Venezuela goes up going forward. In the last 2 years, it's gone up. I think it will further go up going forward. So we will reduce our Gulf dependence to that extent. But nevertheless, the chart number 4 on the lower right side, if there is a partial closure of Strait of Hormuz or a full closure of Strait of Hormuz, in like exactly what Weber was mentioning, the impact of that supply choke leads to a price range somewhere between 86 to $95 per barrel fundamentally. Now, that doesn't mean it will hold on there, it will settle down there. But in the meanwhile, it will first, like any pendulum, it goes to extremes. It will go up, and then as demand supply, the curve where it matches, it will trend down towards this range between 86 to 95, dependent on how much of closure we get to see in the Strait of Hormuz.
Got it. So, Weber, when events like this dominates headlines, do markets tend to price the worst case scenario, or do they usually settle down once supply realities become clearer?
So, as like any event, markets will overreact on either direction. So, if there is some positive news, markets will overreact on the positive side, and if there is some negative news, markets will overreact on the downside also. So that's the nature of the market. So, as of now, the market is assuming that worst case scenario will play out, and uh, crude supply from Strait of Hormuz will be fully shut. But if we look at the kind of efforts the government and regulators and diplomatic channels are making, they are trying to create alternative sources. See, one unique thing about Strait of Hormuz is the impact on different countries will be very different. 80% of Strait of Hormuz supplies are coming to Asian countries. So Asian countries are significantly more impacted than Western counterparts. So, especially for country like India and China, dependence on that is very high. So, right now, market is assuming that Asia will get adversely impacted. India, if you look at the numbers over last couple of months, have dropped our dependence on Strait of Hormuz from 45% to 30%. And with some relaxation on Russian oil, I'm assuming that the gap will narrow further. But all of these things take time to play out. By the time we see impact, market already would have reacted. But my sense is that obviously diplomatic channels are working overnight and they will make sure that the disruption is low. Iran has also agreed to give passage to Indian ships. So all of these put together, the impact will be lower than what the markets had originally anticipated is how I see it. Impact will definitely be there. We should not believe that impact won't be there. But I'm fairly confident that diplomatic channels will ensure that the impact gets diluted to some extent.
Got it. Uh, but an important point that often gets missed is that India today may actually be better positioned to handle oil shocks than we've seen in earlier cycles. The chart on the screen suggests that the current account deficit remains manageable even if crude moves towards roughly $90 a barrel. So, Weber, what structural changes in the Indian economy have improved our resilience to higher oil prices?
So, as Ganesh mentioned earlier, the invisibles in current account numbers has made the biggest difference. So, which is your services exports, GCC, business services exports. All of these have created enough resilience for India's global current account deficit numbers. So that has given substantial resilience to us. Having said that, we should not assume that it's an absolute resilience and will not get impacted. There will be an impact. One thing which might save India is and as it's me trying to find a silver lining here is last year we saw a lot of outflows on account of a lot of large global MNCs listing their subsidiary and taking money out. So pace of IPO has gone down. The pace at which FI sold Indian equity last year has also slowed down. So on capital account front, we might be slightly better off compared to last year because of these developments. So impact to some extent should get absorbed by these two things.
Got it. Coming to the behavioral aspect of it, Ganeshram, when an economy shows this kind of resilience, does it change how investors react to oil spikes such as the one we're seeing?
Absolutely. So investors are absolutely watching this point, which is why the tolerance threshold is very critical, right? Because if you see the chart on the right, like what I mentioned, 2001 to 3, the tolerance threshold was only $40 because our IT industry was still new, our NRAs were sending lesser money, and our BOP dynamics meant so when oil went past 40, the rupee started depreciating, the economy, the investors will start waking. Gradually, that went to 50, 60, 70, 80, and then it's been hovering there. In fact, in 11, 12, it deteriorated because our, the inflation. So when I mean tolerance threshold, I'm referring to at what levels do the current account and the capital account measure each other out, and so the BOP is zero. Okay, so that becomes the threshold, and given FPI flows, our economy size, how much we take, various dynamics, right now our assessment is the tolerance threshold is 90. Now it's gone past 90. That is why there is some bit, and investors will, it is like it is like operating cash flows of a company. The current account is like the operating cash flows of a country. Okay, so the PE multiples, when the company, when a country, when I look at it realistically, look, what we all relate easier, when the operating cash flows of a company weaken, are in negative trajectory and it weakens, you need either debt flows or equity flows to give the company adequate capital to fund its capex. Okay, which is the financing and the investing activities. But when the current account deficit, which is operating cash flows, weaken, the capital flows also tend to weaken. So companies are forced to cut capex, right? Which affects the long term growth. And that is why this is important. But that levels at which the pain comes is what I'm referring to. 80, 90, somewhere there, we are little more exposed.
Absolutely, and along with that, for how long it will sustain plays an important role. If it sustains for a short period of time, then we'll be able to absorb it better. But if it sustains for a longer period of time, then government balance sheet will not have enough room to absorb that. See, the alternative that the government will have to cut the spending somewhere else, and which indirectly will impact GDP growth also. So if government were to take hit of some of this increase, for every 5 rupee absorption that government takes, the impact on government's budget is of 75,000 crores. So, which means there'll be some balancing act that government will have to put in place, like reduction in capital spending or taking higher deficit. I don't think government will go for higher deficit. They may cut down on the expenses. So it's a fairly complex situation, and the longer it lasts, more complex it will keep becoming.
So, Vaibhav, just in the interest of transparency and covering all bases, in this last scenario, if oil stays at $100 a barrel, what are we looking at?
So, see, there are a lot of interlinked points here. So, if crude remains at 100 for a long period of time, then obviously there'll be impact on inflation, there'll be impact on demand, and there'll be impact on corporate earnings. There'll be impact on government finances, there'll be impact on our current account deficit number also. So, the way to think about it, the right way to think about it is assigning a probability to each of these events. I would still say that 80% probability that this will not last beyond a few weeks, and therefore I'll not be too worried about interim crude in the interim crude being at 100 barrels. There is a very low probability that it will last beyond a few weeks, and in that case, obviously there will be an adverse impact on all the asset classes. You will have impact on fixed income, you'll have impact on equity. So you will have impact on currency. So impact will be there across. But when you're deciding, you have to take into consideration probability. So it's like if you go out in a car there is a probability that you will meet with an accident, but you can't work with that when you are deciding to go out. So you need to assign probabilities to each of these events and take a call. It may so happen that you may get it wrong, you may get it right. Either way, markets can make you look stupid in short term. So that is something that we need to be mindful of. But $100 long term, really negative. $100 short term, we can definitely manage that. $100 short term is a high probability event. $100 long term, it's a very low probability event.
Got it. So, as you mentioned, oil price shocks eventually feed into inflation, which affects interest rates and monetary policy. The estimates here suggest that every $10 increase in crude prices could add roughly 50 basis points to inflation. Ganeshram, how sensitive is India's inflation outlook to oil prices in this current cycle?
It is important because companies will try to pass on the impact of raw material prices onto the end customer. So they will not do it overnight to shock. They don't want to shock the customer, but they will have to take gradual price hikes, and it will show up in over the course of the year if that were to play out. Of course, like Vaibhav mentioned, it's all about how long this lasts. If it's going to be a 1 quarter lag pain, also companies may not want to forward it to the end customer. But if it were going to last longer, then you are going to face the impact of this onto the end consumer. Be it directly means what oil companies pass on as the fuel prices, but indirectly what I mean is it will flow on to every level, right? Logistics cost, which say even say the trucker will charge more. That means it'll have an impact on cement prices, it'll have an effect on, and that's when the inflation starts trending up, and that's why uh, oil is very critical for overall dynamics.
Got it. Vaibhav, if inflation pressures were to rise because of oil, which parts of the equity market tend to feel that impact the most?
See, okay, inflation rising for a long period of time, obviously the worst hit sectors will be rate sensitive sectors. Rate sensitive sectors would include your real estate, would include your automobiles, construction, engineering goods. All of these sectors which are sensitive to high interest rates will get impacted. The other impact of that could be on banking and financials also. If interest rates are high because of high inflation, the NPA rates typically go up, and there'll be an impact on that. In that kind of scenario, healthcare, IT, some of these businesses can act as a defensive businesses, and we need to look at our portfolios to see where our allocation to rate sensitives is compared to defensives.
So, oil prices, as both you and Ganeshram have mentioned, also affect government finances, especially if policymakers adjust fuel taxes to absorb price increases. Above, how meaningful could this fiscal channel become if oil prices were to rise sharply, even more than they have already?
So I said the impact will be substantial. Government would not try to compromise on fiscal numbers because in this kind of volatile environment where your currency is under pressure, taking further fiscal risk won't be prudent. Government will try and rationalize their expenses, and therefore GDP growth may go down by 0.5% to 1% during that environment. So it's an important factor because the amount of capital that you have to deploy, if you can put it to productive work, it will give you superior outcome versus putting to use for subsidies, which doesn't give you superior outcome. Either way, pressure will be there on the consumers also. Either they get pressurized through higher oil prices or they get pressurized through high interest rates. Either way, there'll be pressure on the consumer. So it's an important consideration. Again, as I said, all of these things we have to see in the context of how long these things last. We spoke about Russia and Ukraine situation also, where the crude prices went up to 120, but it didn't last for long, so the impact was minimal. If we work with them, then the working assumption for us is that it won't last for too long. Therefore, we believe that the impact won't be that large.
Understood. So Ganeshram, this one is for you. How closely do equity markets actually track fiscal developments when oil prices move?
No, it will be because we will as be it equity investors, we will want to see how much government spending trickles down to the end consumer. Now, I'll give you as an example. Say, assume government is putting up. There is a new airport coming. Okay, there is a new 1,000 kilometers of roads coming, or some railway tracks coming, or whatever, right, port, whatever. Now, what do? 45% of what they spend on capex goes into buying land. Okay, 45% goes into buying land. Whom do they buy land from? They buy land from a farmer, or they buy from collectively, right? So that is money into the pockets, and that money gets spent on two-wheeler. It could get spent on a house. It could get spent on something else, and that trickles down into demand. Now, if government cuts the spending, it does have an impact on the ground. That is one. This is a direct impact. But the indirect impact is very high. You put a bridge. Now it leads to more activity, right? You put a road, it has more impact on. So if you go to a village with a road connectivity, the prosperity of the village is much more than to a village without a road connectivity. That's the indirect. Somebody, he can take his milk and go to faraway towns and deliver it, make more money. So that's the indirect effect. So the government spending on capex is very discretionary, and it is very impactful on the economy because see, 75% of what the government spend is fixed cost, interest cost, subsidy, salary. Okay, but the 25% is where they spend on capex, and that is the big impact on the economy. And like Vaibhav mentioned, the pressure will be such that the government will not want to increase the fiscal, so they will cut capex. That's the sense you get, and that impacts the discretionary spend, which has a big impact on the economy. That's why this slide, the fiscal math, and others get important for equity investors. Of course, it is important for bond yields and the fixed income investors also, because if government borrows more, then it will put pressure on bond yields, on bond prices, and that has an impact on RBI action and the like. So that's again indirectly impacting the equity markets again. So it is all very, very critical, no doubt about it.
Understood. So eventually, like one of the final dominoes that falls is that these macro effects flow through the financial system, affecting liquidity, credit growth, and economic activity. And that ultimately influences corporate earnings, right? So, Ganeshram, how long does it typically take for macro shocks like oil spikes or any related spikes to start affecting earnings?
A quarter or two, typically, if the pain lasts. See, the core thing is, as Vaibhav keeps mentioning, and that is the key. The key is, does oil remain above 90, $100 for 1 month, 3 months, or 6 months to 12 months, right? That's because if nobody will react for 1 month, they will wait and watch, right? It doesn't show up immediately. But if it is 6 months to 12 months, then people have to react.
Got it. Vaibhav, bringing this closer to home in terms of how investors react, what they should do. When these macro cycles play out, how do you ensure that portfolios remain positioned for the long term rather than reacting to the short term noise?
See, two things which are important. First, be true to your asset allocation. We see tendency to take extreme asset allocation calls during these kind of periods where I've seen and I've been experiencing it. A lot of investors move away from their strategic asset allocation to try and take advantage of short-term volatility in the market. But it's impossible to take advantage of short-term volatility in the market. So, for example, everyone would have thought that with this war, gold and silver prices would go up. But on the contrary, these prices have come down. So it's very difficult to trade in these markets. Crude went up by 40% in a day and came back down within the same day. So how do you take advantage of these kind of situations. So you can get stuck in this kind of complex price movements. So the only thing which can save you is good long-term asset allocation planning and sticking to that. And whenever there are imbalances in asset allocation, you correct it and make sure that you are in the right asset classes. That's point number one. Point number two is good news and good prices never exist together. So if there's a good news in the market, good prices will not be there. Good prices will come in the market only if there is a bad news. And today, there is a reasonable amount of bad news and reasonable amount of good prices in the market. So maybe if your asset allocation is imbalanced today, you are under allocated to equity, take advantage of some of these good prices. You can look at your portfolio, also look at quality of the portfolio. It's a great time to assess the quality of the portfolio because as they say in war, there are only survivors. In markets also, there are only survivors. So you have to be in the companies which are going to survive this market. So that's how I would see the uh, action that investors should take.
Understood.
On the fixed income, I'm very clear that you don't have to take duration calls. Good quality bonds are available with a reasonable amount of return. So you don't have to take any duration calls in the market because there is no tailwind there.
So now that we've addressed all of these issues on what's happening, what the potential implications could be. Now, despite all of this macro uncertainty, history shows that periods of volatility often create some of the best investment opportunities, as you have mentioned. This slide highlights the idea of selective investing, identifying sectors that have underperformed, but where fundamentals are improving. Ganeshram, how do you go about identifying these opportunities?
Now, this slide is the crux, right? This is the most important. Now, if you see the last 25, 26-year data, markets have corrected every year. There is a drawdown. You go from 2000 onwards. You see that on the table on the right, the penultimate column from the right, the drawdown, which I've put it in various colors. If you see that every year there is a, I put that start correction, start date, the low point, correction, start value, the low point, how much it fell. And then the last column is the calendar return. Okay. Now you look at calendars like, say, 2003. Okay. In that year, January to April, markets corrected 16%. Okay. But you look at the return for that year, 72%, in spite of 16%, which means from the low point, you see how much money has been made. Okay. Uh, and you even look at, say, calendar year, like, say, 2009. Markets fell again, Jan to March. It fell 18%. But what was the calendar return? 76%. And then you look at this. Now, why I'm saying that is markets have correct, except say maybe 2016, or maybe 2017, where markets fell only 4%. The reason was in 2016, markets fell twice. One is January, February, as you see in the table here. And second is when demonetization got announced in November. Okay. So the markets corrected two times in calendar 16, both times around 10%, 12%. So the calendar 17 saw very little correction. But if you leave that aside, there is almost a correction of double digits every year through this cycle. Now, why am I saying this? Because 21 out of 26 years that the data here tells, if you buy into a 10% correction, you make money. Okay. You make money. 21 out of 26 years. You wait for a correction, for some reason it is corrected due to oil, it is corrected to COVID, it is corrected to war, Ukraine war, it is corrected for financial crisis, it's corrected for because of bad elections. It's like in 2004. If you see 2004, phenomenal year. Okay, I mean, in that period when elections happened, and 2 days lower circuits, two consecutive days of lower circuits when BJP lost in the 2000, and the markets, if you see, it fell 30%. In spite of that, we had a 11% calendar year return because markets recovered. So what I'm highlighting here is in 21 out of 26 years, buying into a 10% correction as markets have corrected now has paid off, has given you, this is the most successful investment strategy in terms of probability and in terms of impact on the portfolio. Wait for 10% correction, put your money in, gives it returns. Okay. Now, there are three kinds of corrections. As investors, we love correction. We love volatility. We like uncertainty. My Ariel has gone up in the last 15 days. In my portfolio, I was sitting on 25% cash as of February or March 1st. As of today, okay. As of December end, I was at 35% cash because I wait for the yearly correction. Second corrections are the point number two in the table. Every year, markets give you a deeper cut in one sector where it would have gone through 3 to 4 year period of no return, like various consumer companies in 25. In 24, it was various private banks and NBFCs or microfinance companies. In 23, it was insurance. In 22, it was autos. Okay. Autos in 22, if you remember the narrative, electric vehicles will kill Bajaj Auto, it will kill TVS Motor, Acer. These stocks had given 4 year no return. Okay. Or in industrials, in companies like L&T or ABB or Tube Investments in 21, 5 year return, nothing. In regional PSU banks, State Bank of India in calendar 20, when COVID hit us, State Bank was 180. It went down, the average price was 180. It went to 150. Today, what is the price? 1000. Okay. 1050. Okay. So this is the second. I try to combine the first correction and the second correction. Okay. It pays off 8 out of 10 times. Okay. It pays off. Then there is the third correction, okay, which happened in 2002, 2008, 2013, and 2020, okay, where the cut was deeper, okay. So in 2002, that is, I'm referring to FY2, okay, which is, if you see a middle, some bit of calendar 1 and calendar 2 on the data here, the cut was steeper. That happened. India was weaker as an economy. Balance sheets were weaker of corporates. The 9/11 happened and the wars had started and everything. That cut and the dot-com meltdown was very, very sharp. Very strong correction. Second, 2008. Okay. Now, and then 2011, 12 in that year, and then the COVID year, right? Now, can you predict these kind of years? No. In probabilities, it is 4 out of 25 years. So it's like something like a 15% probability events. How do you predict it? You cannot. None of us are. We have been in the markets for 25 years. We'll be lying if we told you that we should prepare ourselves for such years. The only thing, as Vaibhav mentioned, is asset allocation. Keep that balance between debt and equity or yield assets and growth assets, which is either REITs or bonds or fixed deposits or any kind of yield assets. That proportion, keep that discipline between yield and growth assets. And in such a year, I, as a individual investor, what I will tell investors is each of these occasions, the bond yield equaled earnings yield. Okay. When that happens, I will make asset allocation changes. I will shift money from yield assets to equities. When that happens, are we in 26? Are we reach that yet? No. Okay. Will we reach it? I don't know. Okay. But if and when that happens, I will make that change. Till then, for me, corrections beyond 10% are opportunities to tap into because 8 out of 10 times this has paid off. I don't know whether the war will end tomorrow. Will Trump come and tell ceasefire? Because I don't know all this. None of us can predict. None of us should prepare for it. That's not how investing works. Okay, you work with probabilities. 80%, 20%. That's the balance in probability, and I will go with it.
Got it. So, Vaibhav, your perspective, both you and Ganesh Ram have briefly touched upon asset allocation and portfolio construction along those lines. But more from a behavioral standpoint, how should investors balance staying invested with taking advantage of these opportunities?
So at three levels, first, review your portfolio, check where the imbalances are in your asset allocation. So if your equity allocation has come down, uh, let's say you started with 50% equity and 50% fixed income. Now your equity is 45 and fixed income is 55. Correct that, bring it back to 50-50. Second, look at the instruments that you're holding in your portfolio. It's extremely important to look at instrument level allocation in the portfolio also, because with every down cycle, when the reversal happens, the winners are very different. So what you are sitting on today may not perform in the future. So that evaluation is extremely important. As Ganesh said, it's not time to be adventurous and change your asset allocation, because we have still not reached that distressed level of equity earning yield being equal to fixed income yield. So I'll explain that concept a bit. So when markets are trading at a PE of 20 times, that means the earning yield is 5%. So which is 100 divided by 20 times PE. So earning yield is 5%. And if your risk-free rate of return is 6%, so the difference between risk-free rate of return and earning yield is 1%. There are times when they converge. So which happened in 2008 when the market started trading at 10 PE, earning yields were higher than the fixed income yield. So these are the times where you take aggressive calls and say that, hey, in equity, I'm getting higher earning than fixed income. So equity relative to fixed income has become safer. And that is the time when you take call on changing your asset allocation. Today is the time where you look at first asset allocation and also ensure that your securities in the portfolio are right. So these are the two recommendations. I've seen this a tendency where people say that in bad markets we don't have to. I can't look at my portfolio. I don't want to look at my portfolio. But that's the worst thing that you can do on your portfolio. Honestly, today is the best time to look at your portfolio. You have to go back and look at your portfolio and see what needs to change.
Understood. Thanks, Vaibhav. Thanks, Ganeshram. With that, I would like to open it up for questions. We have quite a few of them. I'll do my best to condense them and throw them your way. So, Ganeshram, question one is for you. We've seen a relatively good quarter in terms of earnings in Q3 FY26. How do you see this playing out for the next quarter or two in light of what's happened in Iran, Israel?
See, quarter three earnings were good because September 22nd, the GST rates were cut. Okay. So that led to impact coming up in the immediate 3 months. Okay. So I think that trend towards what was continuing in Jan, February also. Some bit of rupee pressure has started to eat into margins, but yet March, we are seeing some bit. And if the shortage on gas and shortage on all of this has started in March. So at a quarterly level, I think there are some deviations which we will see. I think earnings is not the only thing markets will look. Markets will look ahead. Okay, so markets are not backward looking. Markets are forward looking. So earnings is not the only thing we will look. We will look at forward looking earnings and not just backward looking. So it's not Q3 is not very relevant going forward. Yeah, which companies you are buying in the portfolio, a lot of these, what the managements are doing to insulate themselves to absorb shocks on ability on inflation, or do they have pricing power to pass it on? That's more bottom up. That's a decision that we take on whether the companies can withstand the pain lot more than others. How's their balance sheet? How's the industry structure? The competitiveness? Is it an industry with 20 players, or is it an industry with 3 players? It drives ability to take price hikes. All this is very critical in times like this.
Got it. Vaibhav, the next question is for you. How is public and private capex picking up in FY26, and how is this expected to affect earnings for the next couple of fiscal years?
See, government announced a substantial increase in public capex in the current budget. But how it will play out will depend on what kind of fiscal headroom government has of accounting for the disruption in crude supply. So very difficult to answer, but a steady state, I think there'll be reasonable uptick there. Private capex had also started happening. So 31% increase in private capex year on year. So which means there are a reasonable amount of green shoots there. All of these things should sustain in steady state scenario, with the caveat that if this war lasts longer, then everyone will cut back on that, which is not the primary assumption that we have.
Got it. Maybe Ganesh Ram, you could take this. Like, there's been a constant view on de-dollarization and oil being traded in another currency. What is your view on that? And if that happens, like, where do you see that currency shifting to?
I think we should. I think it's a very relevant thing. And if you are a student of history, economics history, and I mean I like that. I go back to the, if you go back to the First World War and ask why did that First World War happen, it was because the imperial world was controlling certain parts, and Germany one day woke up and say, hey, I'm not controlling very large parts of the world. Britain or America or France or Netherlands have taken, so I am going to take the Middle East world. That's when it starts. So they started putting a railway line called Baghdad to Berlin. Okay, they started connecting, and then the Brits woke up and said, hey, if this line comes up, and the world had started building cars in US and in Europe, they said, hey, if the future is oil and if German controls it, then we are dead. We need to ensure that the railway line between Baghdad and Berlin doesn't get formed. So we have to kill it. The World War started from that. That was the trigger for World War. The World War was an ego reaction by Germany, but the First World War, when today China is trying to put uh, the Belt and Road Initiative, which is actually not too different, okay, to what Germany tried. And behaviorally, Germany and China, 100 years apart, behaving the same way. So, is this war? It's actually a trade war. Is it in line? Is it in sync? And is de-dollarization coming from there? Okay, these are all very relevant questions. They don't get answered in 1 2 years. They get answered in a couple of decades. Will that eventually happen? It will, but do we know when it will happen? No clue. Okay, will it happen in short horizons because cycles are shrinking? That's not what history tells. History tells that when USSR died in '89, the problems had started in '75. Okay, when you had Britain as the world's trading currency was pound sterling 100 years back. Did it end in 1 year? No, it happened over 2 decades. Okay, we go back to history, Spanish currency. You go back before that, the Portuguese currency. You go back 1,000 years before that, when Roman Empire was controlling the trade. Did it all end in 1 year, 2 year, 3 years? No. Did it happen over 2 3 decades? Yes. Will it happen? I think it is likely. The way the patterns are very similar, but will it happen in our horizon? And I'm not confident.
No,
Uh,
absolutely. And just to add one more point to here, see, part of this situation is emerging also because of a threat that US sees on petrodollar monopoly. So there is a reasonable amount of linkages there. What started in 1974 as a pact between Saudi Arabia and US that they will trade in US dollar and all the surplus money will get invested in US Treasury. So the moment US in bargain, US will provide them security. Now the core of that is shaking. So US is trying to establish that they are still the leader of the world, and as all the Middle Eastern countries should continue to reinvest their money back into US Treasury. So that's also a ploy. I 100% agree with Ganesh that this will not happen overnight because there is no reasonable alternative available today. That's also an important point here. So it will take decades, and in desperation, under desperation, US will also try many things. We are witnessing some reversal of dollar weakness because We've seen dollar has started strengthening again, and impact of that is visible on precious metal prices also. So it's not going to be linear journey where it keeps going down year after year, month after month. There will be volatility, and unlikely that next 20, 30 years we will move away from US monopoly.
Understood. So, Vaibhav, we briefly touched upon this presenting significant investment opportunities. If you could maybe, for the audience, let them know what segment of the market is looking more attractive in terms of the market caps.
See, there are opportunities across market caps today. We have to look at valuations and also stress test these companies' businesses in the backdrop of where we are today, and then decide. And that's specifically what I mentioned at the outset, that we are looking at our portfolio with three lenses: what kind of margin risk is there for the business, what kind of demand risk is there for the business, and what kind of currency risk is there for the business, and basis that we are constructing the portfolio. And last and but not the least, valuation risk also. So we were discussing, Ganesh and I were discussing yesterday, the kind of opportunities which are visible in banking and financial now is something which is incredible, and that's across market capitalization. In large caps, you have banks, leading banks, which are available at sub 2 price to book, with ROEs in excess of 15-16%. So it's a great price and valuation to buy some of these companies at. Same is the case with the mid and small cap also. If you can get good companies at great valuations with a reasonable amount of insulation from geopolitics, it's a great time to invest in some of those sectors, and we'll look at those opportunities in our portfolio, definitely.
Understood. In the interest of time, I'll take a final couple of questions. Ganeshram, this one is specifically addressed to you. What is your view on the IT sector and new age tech businesses like Zomato, Swiggy, especially given the backdrop of AI and now the crude prices as well?
Yeah. So one, these are not managements who are sleepy. Okay, so it is not like when there is a threat coming, they will also let that threat come and impact them. They are quality managements, and I think they will react. They will insulate their businesses better. They have seen disruptions in the past, so it's not like they are caught, napping or sleeping at the wheel. Number one. Number two, by nature, Indian companies are, they like to react. Okay, they don't like to be proactive. Okay, in especially when there is a new technology initiative, they like to hold the second mover advantage, not the first mover advantage. And if you go back telecom, or you go back to any technology which has come, internet, or you go back over the last 50 years, Indian managements will react. Why? Because we are capital disciplined, little starved. So we want to make billions of dollars investments when the payback is 5 years, and not when, which means they will want clarity. They will react and not be proactive. And so they'll tell, okay, let the world burn hundreds of $1 billion, let the proof of concept emerge. I will come back. I think exactly what IT companies will end up doing in this situation also. They will wait for clarity. They will wait for things to, the bubble to kind of get burst, and then they will get in aggressively because they are sitting on cash in their balance sheet. Now, that doesn't mean that their stocks become buys right away, because we need to understand how long, how much is the disruption. My math tells me that about a third of their revenues are at risk, of IT companies' revenues are at risk, but I also think it will add 20% to their revenues, the new opportunities. So it's going to be a one step, 1.5 steps back, but one step forward kind of situation. So we need to see if the stocks are reckoning that, the pain is reckoning that. I've started the work on this sector. This to me is the sector to do the work this year, but that doesn't mean I buy into it and be that and full put all my contrarian investing into it right away. I will watch, not act too soon.
Got it. Understood. Vaibhav, final question for you. The difference in post-tax yield of earnings and fixed income is larger than ever before. Any thoughts if you should look at pre-tax or post-tax? If you look at post-tax, then the downside is not that much, is what the question states.
So obviously the context is different for different investors. So investors who don't have to pay taxes, they will always look at risk-free rate of return before taxes. So let's say a mutual fund or a insurance company that doesn't have to pay tax. For them, the opportunity cost is risk-free rate of return without any tax. Generally, a good marker would be pre-tax only. I would not consider post-tax because institutional investors use that as a benchmark. And from the promoter's point of view, also the cost of capital versus cost of equity is always pre-tax.
Got it. So before we wrap up, one final question. If investors watching today remember just one takeaway from this discussion, what should it be? Ganesh Ram, maybe you can go first.
I think the most important takeaway for me is the one I showed on the previous slide, that 80% of the time in the last 25 years, data has told us that into a double digit correction, when you put money, it pays off 8 out of 10 times. Okay. So it is important to capitalize on a capitulation rather than run away from a capitulation. To me, that is the most important thing. We tend to buy into bubbles and sell into panic. We should avoid both.
Got it. Vaibhav, would love to hear your perspective.
No, absolutely. And see, the first thing which we need to acknowledge is there is no certainty in equity investing. And second, we need to acknowledge that there is no deterministic answer in equity, it's only probabilistic. When probability is in your favor, you act. When probability is not in your favor, you don't act. So these are the takeaways. Most of the times we work with a deterministic number that equity will always give positive returns or equity has gone down and it will go down further. Equity markets don't work like that. So need to assign probability. When probability is in your favor, you should act.
Understood. Thank you, Ganesh Ram. Thank you, Vaibhav, very much for uh, providing your insights. And folks, I hope we did justice to your time and you've taken away some key insights from today's session. We hope to have you again next week with another session. Once again, thank you very much and have a great day ahead.
Thanks for having me.
Thank you everyone. Thanks for joining.